you're doing well. Each chart type allows us or gives us an opportunity to work with a specific technical parameter. For example, chart types that are trending, one could use moving averages, ADX, Fibonacci supports and resistance, and factor it into their analysis. Whereas when a chart is ranging, it is then that we look at pivotal highs and lows in order to take a decision. Just to clarify, a trend is any security that creates consistent highs and lows, that is, they are predictable and they are in the same direction. Therefore, an uptrending security is one in which repeated higher highs and higher lows are created, whereas a downtrending security is one in which repeated lower lows and lower highs are created. A security could have a dominant trend and a minor trend, that is, it could, under the influence of a larger dominant trend, it could change the trend structure in the intermediate time frames, resulting in a different approach that requires to be taken by traders and investors specific in those time frames. Now, investing is the process of allocating your surplus savings into the market. By definition, savings mean that you have an income source and you have expenses, and the difference between the two is your saving, which you now choose to allocate in the market. Trading is the process of creating an additional income source. In other words, a trader is an individual who is most likely going to enter into the market to create income, then to meet his or her expenses in order to create savings to eventually allocate in the market, perhaps to create long-term assets like equities. In that context, analyzing the primary index of the market that you are trading in is critical, as it influences your decisions in many other securities that you pick thereafter. So in today's video, I thought that we can have a look at the Nifty charts on the monthly time frame, since it has been quite some time that we visited this, and in addition, I thought that we can take some time out and look at the price action slightly more critically and see if we can use simple tools to create certain inferences that may influence our decisions in the future. So currently I have set the time frame on monthly, and what we have is Nifty price action all the way from 1996 to the current 2022. This chart will be used as a case study and as a reference, and therefore what we will start off by analyzing is price action right from the beginning. So I will just zoom into this chart and maybe focus more on what happened somewhere in the first phase, that is 96 till 2008. So as we had earlier mentioned, that a security is in an uptrend provided it creates consistent higher highs and higher lows. Now if we simply use a structure like this, we will note that this low of 830 and this high of somewhere around 1300, 1250 had been in play in the market from 1996 almost till 2004. There was a phase in the period 1999 till 2000 where the market took out this high, but the subsequent double bottom that got created here, in this case it was a multiple bottom, concluded that this was a ranging phase in the market, which means we can decisively conclude that from the period 1996 all the way till 2002-2003, Nifty was in a definitive range. In this 2003 phase, Nifty did break this high, that is the high that it had created in February of 2001, and we can just use this marker as a reference. So just make this black, and we can see that this high was created. In a sense, Nifty created its first instance of higher top. Now once this higher top was created, I think so once this higher top was created, when Nifty retested the 1997 high, we basically got a point of a potential higher bottom. And once we got this higher bottom, the subsequent test of the higher top led to a decisive break, and from here we can see multiple higher tops and higher bottoms that were created. So just to reference, I will move this here. We will see this as a higher top. Subsequently, after this hammer pattern, we see a higher bottom. Later on, once again we see a higher top, another higher bottom, and this process continues till we reach this higher top, and finally this higher bottom was decisively taken out by the market in the 2008 crisis. Now, given that we have an idea that this was a trending phase in the market, we know that we can use trending tools such as Fibonacci's retracement and extensions in order to determine the strength of the trend. So we will take a point which is obvious, clearly the pivotal low, and map it with the clear pivotal high. And what we basically, sorry, this has been selected incorrectly. Use and here. So what we can see is that when Nifty, after moving from 1200 to 6400 in a matter of 3 years, when it pulled back 78% on a Fibonacci resistance level, Fibonacci retracement level, indicating that from this phase we had the index trading in an extremely bullish weak manner. Nonetheless, we move forward and we see that this high was retested 3 years later, and subsequently this high was broken out a few years later. Now, when we see this portion where this high was taken out a few years later, we once again get this particular pivotal low. So we'll just put this portion here, and we will see that another pivotal low was created around this level when Nifty moved all the way till 9200 levels, and this was somewhere around 2014-15. After these 9200 levels, we see another pullback in the market, but from the earlier 78% retracement, we are now seeing that there was a mere 50% retracement, indicating that a bullish very weak or a range with a long bias has now become a bullish weak trending security, that it is more likely to trade on the upside than it is on the downside. And we obviously got these clear confirmations because this high was eventually taken out. So whenever this high was taken out, we know that this was the higher bottom. So let us see. So eventually this high was taken out in a clean manner, and this high got taken out all the way till here, which means that it gave us another Fibonacci because a higher top was created, which means we can use Fibonacci pullbacks again. So just by connecting these points, we now see that Nifty once again during the COVID fall created a 78% retracement. So we have seen that historically when the market has moved as high as it has moved, it has created 78%, 50% and further 78% retracements at various points in time. And now the question is, if we apply the same logic here, where do we see Nifty? So once again we connect it from this COVID low and connect it here to see that currently the index is at a mere 23% retracement. Now if the index were to correct all the way till 50% retracement, that would be till somewhere around 13,100 level. In that case, it would be consistent with the retracement moves that it has done in the past. So for example, we have identified that during the period 2012 to 2015, when the index moved almost two times, the retracement that happened was 50%, and this has been the most shallow retracement that the index has delivered over a 20-year period, or maybe longer, 96 to over a 26-year period. So we therefore get that if the index were to indeed create a new high after a mere 23% retracement, it will be the most shallow retracement in recorded time frames. Is it possible? It is very much possible. Is it impossible? These are questions that we will perhaps try to answer at a later date. But now the question here is that given given that we have the index trading near the 23% retracement, do we need to buy this now? Should this be the time to buy now? So first thing that we have to have a clear assessment on is that there is, without ambiguity, this is a higher top, and when we have a higher top, we are just asking the question, is this the higher bottom, that is this low near the 23 and 38%, or will the 38% retracement be the higher bottom? You would have seen many analysts claim 14,300 as a potential target on Nifty, and this is how they're largely deriving these numbers. Or will Nifty go and do what it did earlier in 2012, from in the fall between 2012 to 12 to 15, the correction at 2016, that's a 50% retracement at 13,097, or will it come all the way somewhere between 11,000 to 10,000 levels, which is a 78% retracement that it has done during panic phases such as the COVID fall or the 2008 crisis. So the question is, where do we put the current inflation, the current situation in Ukraine, potential tensions, consistent tensions between Europe and Russia for the longer term, and how do we judge the potential correction in the market? That is, should the market just create a new high from here, or is the market likely to fall further? It is very difficult to make predictions, but I am of the view that there is no reason for the market to create such a shallow pullback, that the market has a tendency to attract maximum volume, and this level, so I'll just remove these additional Fibonacci levels because I think I've pretty much explained the concept. So we are looking at, obviously we are looking at the current price action, and we are seeing this in the backdrop of 2020. So we will see, we know that whenever a security creates a higher top and then moves on to creating a higher bottom, that is a breakout from a clear range. So you can see that this is a range. If we have, this is a very simple channel that the market traded in for quite some time. Some people could argue this is a wedge, but it is not expanding in that manner. Nonetheless, we can see that multiple that inconsistent highs and lows were created. The higher tops were not decisive, and therefore this is definitely a range. So we can see this similar range now of this nature getting played out here. So if we just connect this and somewhere around this, yeah. So now the question is basically that, does the breakout happen on the upside, which means that we are looking at a potential price action. If I could take a trend line, so which would mean something like this. I'll make this blue and I'll make this dark, followed up. So the question is this likely to happen, or is this move likely to extend, or is it likely to come back in this channel and then continue further? These are all the possible scenarios that actually do exist and need to be factored in our taking of a decision. So to answer the question whether or not we should go ahead and just buy into this correction, into this 1 year correction, I would say that given that this is the most shallow correction in recorded history, if this correction indeed has to hold good, then the up move that would follow would be so strong that we could afford to wait for confirmations. And as an investor who is looking to look at the markets maybe once in a quarter, the monthly time frame is perfect, because now what you will start noticing is that as we zoom into the price action slightly more closely, we can start seeing for tactical confirmations. So we will, for example, see that this is a shooting star. Okay, this shooting star got followed up by a bearish, this is a classic bearish engulfing. So we had the shooting star somewhere around October a bearish engulfing that followed in the month of November, a doji that followed in the month of January, and the confirmation of this bearish engulfing only came in the month of February. So this is the bearish engulfing confirmation. But no sooner than the bearish engulfing confirmation was formed, we see that in the month of March there is this bullish piercing candle. So we are now seeing a bullish piercing which is waiting for a confirmation, but instead of getting a confirmation, we see that a new high got created and yet the market closed in lower, which means the bullish piercing did not get a confirmation and the move continued lower till finally in the mid of July. So we have not yet concluded this month, but in the mid of July we are looking at the formation of a bullish engulfing. So at this time this is a bullish engulfing getting formed and a confirmation is due. So which means that first of all it needs to get formed, secondly a confirmation is due, which means that the month of July should close where it is or higher for this to happen, or more accurately would be that it should close significantly higher than 16,600 for this to qualify as a big bullish engulfing, and the subsequent month must close decisively in green for us to take a long side bet with a stop loss of this level. Which means that let us assume that this today were to be the last day of July, which is not the case, but let us assume this were to be the last day of July and the subsequent month we were to get a green, let us assume somewhere near 17,150, 17,200 or even higher, maybe 17,400, then there is a case to consider going long at the subsequent dip with a clear stop loss of 15,150. So should we buy now? Using these charts, obviously we are not seeing any kind of confirmation, we are just seeing a bullish engulfing getting formed, but the confirmation is due and it is still to fully form, and we are seeing that the market is showing a very shallow pullback. So there is no real reason for us to aggressively buy onto a potential high of an engulfing candle, but rather if we are betting that this low is to confirm that it is going to be there, so we are either going to buy into a subsequent dip or wait for a clear confirmation and then look at buying. This approach obviously is only applicable for Nifty at large. There are various subcomponents of Nifty, and what we will do is we will also try to see the same security from the perspective of perhaps a positional or a swing trader. So just to clarify, we had discussed this from the perspective of an investor who is looking at a potential. So here we have this structure, just choose this as a channel because there is a potential that this particular investor might be thinking that this is the formation of a flag pattern, where this obviously becomes the pole of the flag. Okay, and if this investor is to be accurate, then once the flag pattern decisively breaks out above 17,700, it has an absolutely I would say it has an obscene target of roughly 29,000 Nifty, and that too you could say within like 17-18 months. So that will be a very high paced market, and during that when we look at individual stocks, there will be a lot of opportunities for us to consider. We don't have to be the first set of people to jump and support the market at a mere 23% resistance for the potential formation of a flag. We have to learn perhaps to wait and to see. So just to have a better understanding, we will also try and see this from the perspective of a positional trader by simply shifting the time frames on the weekly. And now a positional trader is more likely going to look at the market much more closely and not really look at what happened in 1996, for example, because that aspect of price action has been played off into various levels and need not be a part of his or her decision making. So here this particular positional trader would be seeing that he would clearly see that this was a higher top. Just to mention, it's not very difficult for this trader to see that this was a higher top, and subsequently this was the higher bottom that got formed. after which the market very effortlessly created a new high. So from the higher bottom we would simply use a retracement level and connect it to the high, and then just extend it horizontally in order to see where the markets are positioned. And now from the perspective of a swing a positional trader, he is seeing the market pull back to near 78% of the previous resistance and of the previous up move. So a 78% pullback on this time frame at best is going to give him a trend bias of long with a range bias, range with a long bias. That is, he is not going to call this a bullish strong or even a bullish weak trend. He is essentially going to, or she is essentially going to term this trend structure as a range with a long bias. So broadly it is a range, and if the individual zooms in now even further closely to see what is happening in the price action, what we are basically getting is a clear higher top formation followed up by a higher bottom. So I think this would be a good higher bottom. After this higher bottom, we now see a clear lower top. This is not a double top. To be a double top, it would have had to reach 18,600, but it only managed to reach 18,300. And in this, we see a lower bottom. Okay, you will also note that at critical lower bottom, so for example this is a classic bullish engulfing, so we'll just mark this because it's just too textbook and it serves a good academic value. So we see a bullish engulfing. It is obviously the responsibility of the listener to Google bullish engulfing. You will see that by definition the security needs to gap down, then close higher, engulf the previous candle, and this is clearly gapping down. I mean, after the close of 16,250, Nifty opened at 15,865 to form a bullish engulfing and then to confirm the bullish engulfing. And here you will see a very textbook evening star. This is a very textbook evening star. So you would begin to notice that once the market is in a range, in a wide range, at critical points of the range, it very easily forms your textbook candlestick patterns, and ranges therefore, because candlesticks are very quick patterns to act, ranges therefore are tougher to trade than long lasting trends, depending on how you are seeing this. And anyways, so we see the evening star. We subsequently see that this evening star was accompanied with a lower top, and from this lower top we see another lower bottom, and currently we are seeing the price in between. So we are now, if we had to see where, so since we have this pivotal point till this pivotal point and we extend it, we are currently seeing that the Nifty has retraced up to 50% of the downward swing. If Nifty were to retrace up to 78% of the downward swing, this particular trader at this point would give this a range with a sell bias. Alright, that is if Nifty were to retrace all the way till here. But if Nifty were to retrace till up to 50 to 68%, he would give a weak sell. Had Nifty just corrected from 38% retracement, had there been a pullback downwards, then it would have been a strong sell. What I mean by this is, had the price action moved after this lower bottom only till somewhere around here, which is 16,295, 15,995, you remember, is a critical support point coming from multiple. So had it just continued till here and then from there the price action would have gone lower, this would have been a bearish strong trending on the weekly time frames. Given that this has already gone till here, the best case scenario is a weak sell trend and a possible scenario is a range sell trend. For the trader, for Nifty to completely change this bias, it needs to first decisively break this lower top and thereby in the first instance create a higher top. And so we will just I'll just mark this in italics because we are visualizing this. Sorry. text. So it's not come in italics for some reason. Yeah, no. So it has to first create this higher top. It need not, so on the long term it will be a double top, then it needs to come lower, and subsequently after this higher bottom is created, it needs to take this out. Only then could this particular trader say that the trend has decisively reversed on the long side. Till that much time, any trader looking on the weekly time frames is going to be open to the potential of a sell on the index, and given that the pullback, despite being a year old, is so shallow in nature, that is, it is just 23% of the historic move, that there is a potential that the sell side could continue till maybe 50% or more on the Nifty. So with this we see that the same chart structure seen, the same security seen by different traders on different time frames is going to create a difference of opinion, and no one is right or wrong. The idea is simply to ask yourself the question: if the market is creating lower top, lower bottom on the weekly prices, do you buy such a market? And that is the question. It does not mean that when the market is creating lower top, lower bottom, that everything in the market is creating a lower top, lower bottom. Just for example, if we look at Nifty Auto, okay, this is not a lower top, lower bottom. This is a clear-cut breakout. So in other words, what we are discussing is only applicable for Nifty and the key constituents of Nifty that are forming the price action of Nifty. When we want to form an opinion, say for example on something like an ICICI Bank, we will look at ICICI Bank and clearly we can see that there is no high, no low. This is in a range with a decisive with a triple bottom around 675, double with a double top near this level. We can see this gap, this thing level at 765, and it has taken this out on the eve of its quarterly result. So coming back to Nifty, we are only looking at Nifty and the key constituents of Nifty to form a general opinion, that is, should the money come out from the fixed deposit at this time, or should it just be there and a potential time later in the future we can see. It does not mean that you put 0 rupees in the market, because allocating rupees 0 in the market would mean that you are giving 0 chance to create a new high. Now that's not right. Okay, 0 chance to create a new high, that cannot be right. So which would mean that maybe you will give it 10% or maybe 15% or 5% of your portfolio allocation, but nothing beyond that. Your general investments will continue, largely because you are just seeing a shallow pullback on a very long term time frame, and that should be the general approach for an investor. And of course, when you see this on the daily time frames, this is where basically bulk of your traders would be analyzing Nifty. And these traders would be seeing that after creating a lower bottom, the market is definitely in some kind of a range, but when it moves in this manner where a new bottom has been created, there is always sufficient reason to be very cautious in the market. So for example, if you could look at a stock like Nifty, so Infy, so we have a double bottom here, which is fine. We have this morning star, you will note this right here, the double bottom, this low breaks, and immediately we get a confirmed morning star, which means there is no doubt that this 1380, 1370 level is going to be a strong support. But what we are basically getting on the daily is a clear bullish engulfing, a bearish engulfing on the high of a resistance. So we are getting a high of a resistance right here, and we are seeing a bearish engulfing. A bearish engulfing will need a confirmation, but given that we have the results coming out perhaps on a Sunday and the market will open to these results, it invites an opportunity to trade if at all the stock is to slip anywhere lower. So as a positional trader on the daily time frames, you would look for a breach of 1490, maybe coming to 1480, and then on a retrace of 1500, 1495, you would perhaps short this stock with a stop loss above 1550. So you will take about a risk of somewhere between 60 points on the stock and sell it. And because during the day you are seeing the confirmation of a bearish engulfing, and if of course if the stock is to fully recover and close in green, say near 1520, and there is no confirmation of the bearish engulfing, you don't have to wait for your stop loss to get triggered. You will simply exit. So yeah, we should not mistake what we are doing in Nifty and for academic purpose, to have this as a general view on all the 50 stocks that are listed there, or all the 750 stocks listed in the small, large, mid cap section. We should look at each index and each stock on its own merit. For example, you would be very happy to see an index like this. See, this is FMCG index. You will see how this is obviously your bullish piercing. This is the clear confirmation. This is a breakout happening as we speak. And if anyone is truly looking to invest in the long term, even tomorrow, that is at 42,500 level, which is at an obscenely high price, there is no doubt that the trade is planned with a low of 33,000, which means that if you can risk 10,000 rupees per unit or 25% stop loss on this particular index, you can comfortably take a trade. And as time moves by, you can gradually move this, what is 33,000, to say somewhere around 35,000, eventually to 37,000. Then we know that half points of breakouts are also support, so 39,750. This is a classic Insen kind of a candle. So with this information, you can then start trailing the index. And yeah, so in general, I hope that the overview that we had on Nifty and the study that we did on the longer time frame helps us in understanding a few strengths and limitations of technical analysis, and to see how we can best take a decision. One of the key recommendations that I would make is that previous highs are are points of support. This 12,450 Nifty, I mean, if you would be aware of say something like an Elliott wave kind of a theory, where they would I think let's say, for example, if this is the starting point of the wave, this is the point wave A, and if we are looking at wave B, as long as the wave B stays above the high of this level, this 2020 high, we are in for we can continue with the potential. We are still looking at a potential strong upside. So we could be, I would generally recommend that when we are trading the longer time frames, be more patient in your approach, and respect the previous lows, because if the previous lows are taken out, the downside that comes is pretty sharp and very quick. So this covers the assessment on Nifty, and just to have a further assessment, we would like to see if we can extend this to, say, for example, certain currency pairs. So for example, we can just select the Euro INR, and here we see clearly that this high of 2013, August 2013 of 91 is not yet tested. And we can see that the Euro INR has been creating higher lows, but not very strong higher highs, which means that this trend is so weak that there is no point putting Fibonacci or moving averages. Such weak trends are traded through trend lines, and trend lines are at best a visual approximation to cover maximum pivotal lows. And we can clearly see that if we extend these lows, I mean, you could obviously do clear approximations. We would see that somewhere around 77, 78, this would be a level where a long-term investor in the euro could consider, which means that when the price action reaches here, we want to see something like this, like a this is what we call as a, so I'll just zoom into this. This is what we call as tweezer bottoms, where both the lows are the same. We have a green candle and a confirmation a couple of months later. This looks like a bullish Harami pattern, but it is not a textbook Harami. We would have wanted the gap a little higher. And now this is when the security is trading between the highs and obvious lows. This is in a no trade zone, because we are looking at the monthly time frame. If you were looking at the hourly time frames and it was at some pivotal level and you were trading using those charts, you could do it. But if someone were to look at the monthly time frame, it makes little to no sense to create positions in the euro till it reaches a critical level and bet in the direction of the level. So we can see that it has a mild upward bias. We would want to buy it. In the extreme shorter time frame, we are seeing another tweezer bottom, but this tweezer bottom has just been broken, and therefore this is not applicable. So in the very least, we need at least one full green month and a confirmation to take a decision at this level, to decide whether or not we intend to defend 79.5 with our money. If that confirmation is not there, we will just watch the euro reach a level where it is reasonable for us to actively look for confirmations. We can extend this and see what's happening in the JPY INR. Okay, this is even weaker. The high was tested and the low is getting tested. This is just clearly a range. There is no real trend here because no significant high has been created since 2012, and 10 years of no high typically implies that the security is in a range. And if the security is in a range, the question is, where do we participate in the range? It is very difficult because at every point there is some justification to enter. And given that 80% of the securities range, the question is, why would you want to trade a ranging security to begin with? Speaking of non-ranging securities, we can look at the USD INR. Now this is such a textbook uptrend. We clearly have a higher top, and the best thing for a dollar investor is this amazing saucer pattern. We know that saucers are patterns which form after deep consolidations, and what they can clearly do is give us a very good stop loss. That is a pattern, that a low means this low of 72.2. This low is not a random number, but was created during the price action of 2020 all the way up till 2022. So for 2 years this low has held. Anyone can buy into the dollar with a stop loss of 72. So the question is, would you want to buy at 80 with a stop loss of 72? I think you wouldn't, basically because this after this breakout we are only looking at a potential target of up to 82.5. so I would give this here, and at which point it has to maybe form a handle. So which means that if the price action I had to visualize would be something like this, then there is some handle. Now the question is whether it comes all the way till here or it stops somewhere around here is another question. The only advantage of this is that we might be buying it back at this 80 levels, but only maybe 4 months later, so the current up move in the dollar could continue, and maybe 4 to 6 months later, when it is in the process of forming a handle, we will certainly, it's very safe to take a bet that the previous low will not break. And if the handle is forming above this level, above the previous high level, say somewhere around here, it's a very strong handle. And if we see, once we see any move in that direction, it is critical to start taking positions, because like we discussed earlier, as per Elliott theory, the previous high has not been breached, and therefore the ensuing uptrend could potentially be very strong, and we would love to participate in such a strong trend. So I hope this video has been of some use to you. You have received quite a few queries regarding trading, money management and other principles. I will try to answer these questions subsequently. I wish you the best. Thank you for watching. Bye.